If we look at the price performance of Bitcoin, and we do have to look at price because it's a measure of its trust, it's following very closely previous halving cycles, and that implies Bitcoin should be around 100 to 150,000 in the near term, but could easily get close to 500,000 in 5 years. At 500,000 per Bitcoin, it would still be less than the value of gold today. And I think Bitcoin will surpass the value of gold, which would put the value much closer to $1 million per Bitcoin. Today, we're recommending at least 2 to 5% into Bitcoin, but that is as a commodity or alternative exposure. Because if they invest 2 to 5% of their money and somehow crypto goes to zero, they didn't lose everything. But if Bitcoin reaches some of the targets we expect, then Bitcoin could end up becoming 50% of their portfolio again.
Tom Lee emphasizes that Bitcoin's price reflects its intrinsic value, trust in an increasingly trustless world. For over 8 years, Lee and his team have championed Bitcoin as a core investment asset. When examining Bitcoin's historical price trends, it closely aligns with its halving cycles, periodic events that reduce the issuance of new Bitcoin. These cycles, according to Lee, suggest a potential near-term price range of $100,000 to $150,000, with a 5-year projection nearing $500,000. Notably, even at this level, Bitcoin's market capitalization would remain below gold's current valuation, implying further growth potential. Lee envisions a future where Bitcoin could surpass gold's value, potentially reaching $1 million per coin.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
To us, Bitcoin represents one of the most trusted assets in the world because we're living in a digital age where AI and cybersecurity threats have really undermined trust in both dealing with each other, but also in financial institutions. The Bitcoin blockchain is still the most secure ledger in the world. It has not had a single hack in its 14-year history. And that means the price of Bitcoin represents the value of trust in a trustless world. We've been recommending Bitcoin for 8 or 9 years, and it remains, in our view, a core asset. If we look at the price performance of Bitcoin, and we do have to look at price because it's a measure of its trust, it's following very closely previous halving cycles. And that implies Bitcoin should be around 100 to 150,000 in the near term, but could easily get close to 500,000 in 5 years. At 500,000 per Bitcoin, it would still be less than the value of gold today. And I think Bitcoin will surpass the value of gold, which would put the value much closer to $1 million per Bitcoin. I think Bitcoin is something you don't want to own if you believe there's another way to measure trust. I think that's many years away because even the United States may potentially own Bitcoin as a reserve asset. That is a huge endorsement of the security of the Bitcoin blockchain. I generally don't try to advise people on allocation because how much someone puts into bonds, and bonds are less risky, depends on their tolerance for risk and their age, and also how much money is in the stock market versus their total net worth. So those are 3 variables that I don't know, and that's why we don't usually advise an allocation mix. But I can say that we've recommended initially, when we first wrote about Bitcoin, that investors put 1% into Bitcoin. And if they didn't sell that Bitcoin, even with the stock market gains, it's now 40% of their portfolio. And if our second suggestion was 0.5% into Bitcoin and 0.5% into Ethereum, and that is now 80% if they didn't rebalance. Today, we're recommending at least 2 to 5% into Bitcoin, but that is as a commodity or alternative exposure. Because if they invest 2 to 5% of their money and somehow crypto goes to zero, they didn't lose everything. But if Bitcoin reaches some of the targets we expect, then Bitcoin could end up becoming 50% of their portfolio again. We've followed crypto for 7-8 years now, and we've seen many what they call altcoins come and go. I think the most important thing to think about if you're going to buy altcoins is, number one, if you're investing in an altcoin, you should measure how useful that token is or the size of the community. By that measure, Ethereum and Solana look like very credible blockchains, layer 1 blockchains. But the second thing to keep in mind is that when crypto is in what they call crypto season, when it's in a bullish cycle, the altcoins do very well. So if Bitcoin can go from 90,000 to 500,000, many altcoins will do better, but those are not investments, those are trades. Trump is one of the most market-friendly presidents ever, meaning he's going to focus very much on and rate his presidency based on how the stock market does. And so that's good for investors, because if he introduces policies that worry markets, like deficits too big or tariffs too aggressive, he'll see it in the stock prices. I think the safest way to navigate this from our perspective is to focus on things that we all agree he'll pursue. Deregulation, pro-business and market-friendly, which means financials and small caps, but he does want to make the government more efficient and even do tariffs. So I think multinationals are a little more challenging, and industrials like defense would be challenging, and of course negative for healthcare and energy. From a bond market perspective, I think interest rates are initially rising because of concerns about deficit spending. But again, that's negative for stocks. So I don't think that Trump nor his advisors want interest rates to go up dramatically. So I don't think interest rates are going to be the reason stocks underperform. And then from a crypto perspective, it's clear to me that he's pursuing a very pro-digital assets platform. I mean, he ran on the idea of Bitcoin potentially becoming a reserve asset. Almost all of his key advisors are large owners of Bitcoin. So I think Bitcoin is going to be very central to the White House initiatives over the next 4 years, which of course is positive for Bitcoin.
Lee discusses the implications of government policy and leadership. He describes former President Trump as one of the most market-friendly leaders, with policies favoring deregulation and pro-business initiatives. Such measures, Lee argues, could bolster financial markets and benefit digital assets like Bitcoin. He envisions a scenario where both the White House and the Federal Reserve adopt accommodative stances, creating a favorable environment for equities and cryptocurrencies. Addressing common concerns about demographic shifts, Lee debunks the notion that retiring baby boomers withdrawing from the stock market will act as a significant headwind.
Too early to know how this relationship will work. I think that's the mistake investors make, is trying to think of the market in a very simplistic way. To me, over the next 4 years, there is a White House put. If the stock market starts to fall, this is going to drive some action or communication from the White House. As you know, whenever there's been a Fed put, when the Fed is dovish, then investors are confident buying stocks regardless of circumstances, because they know the Fed is protecting the stock market. Over the next 4 years, we might have both a White House put and a Fed put. I think that's very positive for stocks. I wouldn't overthink it. Federal Reserve is designed to be an independent entity, and it's important for markets to believe the Fed is independent. But every president has tried to influence the Fed. It's not just Trump. Famously, LBJ tried to influence policymakers. I know Greenspan faced a lot of pressure. Every Fed chair has been pressured by the White House because the Fed controls the economy. So without question, the Fed's goal is to ensure employment is full and inflation is low. Those kind of align with what any White House wants to do, but the timing isn't always the same. I think ultimately the Fed needs to push back and sound independent, but I don't think the Fed and the White House are opposing each other. There are many people who are bearish because they say baby boomers are going to take money out of the stock market as they retire. And as you pointed out, baby boomers have been doing this for 8 years, actually close to 28 years if you take the oldest boomer. And if we look at the last 28 years, the stock market has gone up. The reason it's gone up is that the baby boomers control over $120 billion of household net worth. The interest income from that is close to $7 billion a year. Sorry, $7 trillion a year. It's 120 trillion and 7 trillion. I may have used the wrong numbers. The US GDP is 25 trillion. There is so much money saved by the boomers. If the stock market goes up 20%, well, they just made 30 trillion, okay? They're not going to consume their savings. That's a very big misconception. In fact, as you know, household net worth in the last 28 years has exploded. So the boomers are spending a lot of money and living very well, and that's helping the economy, but there's still a lot of money left. And that's going to be transferred to millennials over the next 20 years. There's many people who can model this simply, but the median estimate is roughly 80 to 100 trillion will be transferred to millennials over the next 20 years. The average millennial will be somewhere between 35 and 45 when they receive this money, and that's going to be very stimulative not only for the economy, but will also be stimulative to equities because they're more likely to own stocks than a boomer. I don't know if someone should try to model that precisely because we don't know what the mortality is going to be and we don't know the composition of portfolios. But if someone were to just make a simple observation, for the last 15 years, every single bear has told me the same thing that you just said. Baby boomers are retiring. It's a headwind for the economy. It's going to be a headwind for stocks because they're withdrawing money. And if they acted upon that, they missed out on 15 years of prodigious stock gains. So that would be my answer.
Lee underscores Bitcoin's potential to become a reserve asset. He envisions a future where even governments, including the United States, hold Bitcoin as a strategic reserve, further legitimizing its role in the global financial system. As institutional adoption accelerates and trust in traditional systems wanes, Bitcoin's unique position as a secure, decentralized asset becomes increasingly clear.